Okay, in part two, we're going to take a little bit different step, and let's talk about international investment. So, we're going to talk about the globalization of securities markets. Now, the idea behind wanting to invest internationally, there's obviously several advantages, maybe, but one of the critical advantages is diversification, right? The inclusion of different kinds of securities that react differently could have the potential to increase returns and reduce risk. Certainly, we would at least like to be able to reduce the risk of gaining the wealth that we're looking for. So, again, we can increase diversification a couple of ways. We can look at a wider range of industries and securities. We can look at securities traded in a number of different markets. And then third, we can look at securities denominated in different currencies. So we're going to look over the next several slides, some concepts, some terminology, quite frankly, more than anything else, about investing internationally and how we can get that done. So currently, the securities exchanges, they're all over the world. The top four are the New York Stock Exchange, the NASDAQ, the London Exchange, and the Tokyo Exchange. The London Exchange is referred to as FTSE. It's the Financial Times Security Index. And the Tokyo Exchange is referred to as Nikkei. I'm not sure what Nikkei stands for. If you increase the number of mergers and arrangements between securities, and there's definitely some movement towards a worldwide stock exchange. The same things that have happened to the stock markets have also happened to the bond market. So again, there's a lot of investing internationally in a variety of ways of how you invest stocks and bonds on the world. So what's the benefit, right? Obviously, opportunities for higher returns. Second, we know that federal or foreign stock markets don't necessarily move the same as the United States stock market. Therefore, we have some opportunities for diversification. And finally, with the foreign securities markets, these tend to be a little bit more riskier than the U.S. markets. So therefore, that's the reason for the higher returns. So again, there's lots of reasons why investing internationally could be good for us. So how do you invest in foreign securities? You could do it indirectly. And when they say indirectly, what that means is they're saying if you purchase the shares of U.S.-based multinational companies with substantial foreign operations, you get some diversification. And I am not sure that the research actually shows that. Investing in domestic companies, the primary business is domestic. So I'm not sure that diversification is going to be that's the best way to get, in quotes, international into your portfolio. We'd like to find some more direct ways to do this. You can actually purchase securities on a foreign stock exchange. You can buy securities of foreign companies that trade on the U.S. stock exchange. There are also securities referred to as American depository shares or receipts. Again, these typically are stocks that are trading on the U.S. exchange, but they allow investors to hold these shares and trade them on the exchange. And typically, these shares are backed by what we refer to as ADRs. It's a receipt, right? So there's a receipt at a bank that represents a stock of a foreign company. So this, again, another way to directly invest in a company. The difference between this and buying at a foreign stock exchange is the currency that you need. If you're buying them in the United States, you need dollars. If you're buying them off the Nikkei exchange, you need yen. The fourth way that I think was kind of left out by the textbook here is actually buying international mutual funds that only invest in securities from outside the United States. So again, if you truly want international diversification, and again, we'll talk about mutual funds later on in the text and in this program, you want to buy an international mutual fund. What about the risks that are involved? The usual investment risks always apply, but now we need to add some more things. We need to add government policies risk, right? Different laws in trade, different taxes, different regulation of securities markets, right? So again, we have to worry about stability of the government itself. We also have to worry about currency exchange, right? Currency exchange risk is that risk caused by varying exchange rates, right? Exchange rates, just like stock prices, change every day. So that rate, if it changes, it's going to change, and it can affect ultimately the rate of return. So the value of a foreign currency obviously changes relative to the US dollar. And obviously those investments, foreign investments, are going to go up or down with the exchange rates from those countries. So this risk is apparent in much of our investing internationally, and quite frankly, just doing trade internationally. So let's think about a quick little example here, right? You want to buy a piece of equipment that costs 80,000 yen, and the current exchange rate is 113.275 yen per dollar. So what does this cost in US dollars? Well, here's what we have to do. You have to think a little bit about the exchange rate that you use. We want to move 80,000 yen into dollars. So we need the number that's going to be yen per dollar. 80,000 yen per dollar is going to create roughly $706.25 is what this piece of equipment costs. And we'll talk about this in some examples, etc., at a later time. Last year, we purchased 100 shares of stock in Europe at 95.25 euros per share. And the exchange at that time was 0.7262 euros per dollar. So currently, again, a year later passes, it's selling at 102.5 euros, and the exchange rate now is 65 euros per dollar, or 0.65 euros per dollar. So what gains have been earned in both currencies? Well, if you look at, for 100 shares, it started at 9,525 euros. Now it's worth 10,250 euros. That means in euros, we actually gain 725 euros. And of course, you can calculate the rate of return on that investment. But if we convert this back to US dollars, right? We purchased at 6,917, but because the exchange rate dropped, even though the value in euros went up, the exchange rate went down. Now the value in dollars is only 66.62. So in US dollars, we actually lost $254 in US dollars. So again, the purpose of this exercise is just to illustrate that you can make money across the board in different currencies, but when you convert it back to your own, what that number is and the sign of that number can be different. You can lose money internationally, but if the exchange rate moves the right direction, you can actually make money at home, even though it shows a loss in the other currency. Of course, we know that we have to worry about trading hours, right? When can you trade? The regular trading sessions for U.S. exchanges is 9:30 to 4 o'clock. There's lots of exchanges are starting to offer extended trading sessions before and after regular hours. There are some securities that are allowed to trade 24 hours a day. Again, what this does is it allows the U.S. markets to compete a little bit more with foreign securities markets, since the globe, obviously we know we have different time horizons, right? We have different, I can't remember the word right now. We have different time stations across the world. So Central Time, Eastern Time, Mountain Time. I mean, by the time you get to Japan, right, it's actually almost, I think it's like 12 hours difference in time. So it allows us to compete a little bit more with those foreign exchanges. There's lots of regulation in the securities world. And I know that from time to time, regulation gets a bad rap. And for a lot of times, I think it's well deserved, right? We do have a tendency to make too many rules that in the end constrain business from happening. On the other hand, I believe that there are enough unethical, bad people in the world that if we don't have regulation, we are placed in disadvantaged roles, since we don't know all the information that there is about certain kinds of investments, etc. So for that matter, then, we need to talk just briefly about regulations. The Securities Act of 1933 covers the primary market. It talks about the public offering of securities the very first time. The Securities Exchange Act of 1934 covers the secondary market. If you remember, we talked about the difference between the two. One is it's the company selling. That's the Securities Act of 33 covers those actions of companies that are issuing their stock. And then the Securities Exchange Act of 34 covers those people who are trading the securities after it's been purchased the first time. The Maloney Act of 1938 created some organizations. The primary one was called NASD, National Association of Securities Dealers, and this was an organization that self-regulates the securities industry. Now it's currently called FINRA. Not exactly sure what FINRA stands for, but essentially the securities industry is self-regulated. The SEC obviously covers a great deal of this, but when we talk about the industry, we're talking about the brokers, the brokerages, etc. Those folks are regulated by the NASD. The Investment Company of 1940 created and regulated mutual funds. The Investor Advisors Act of 1940 required investment advisors to fully disclose their backgrounds, their investments, as well as to register with the SEC. Right? You want to make sure that whoever you're working with has been properly trained, has at the very least has passed the testing requirements for selling securities. The Securities Act Amendment of 1975 got rid of fixed commissions, made the marketplace obviously a little bit more competitive. We've had an Insider Trading and Fraud Act, 1988, obviously placed much higher regulation and scrutiny on the trades of those people inside the company that have inside information. We have the Fair Disclosure Act, required companies to disclose material to all investors at the same time. So what would happen is sometimes it would leak out. They give information to a certain group of folks. Now they can trade and make money. Well, we want to, it has to be provided to everybody at the same time. And the last two regulations are something that, unless you've been in a coma over the last 4 or 5 years, you've heard of. The Sarbanes-Oxley Act tightens the accounting and auditing guidelines to help reduce corporate fraud. And the Dodd-Frank Wall Street Reform Bill was geared towards the banking industry and accountability and transparency. And this is the act, quite frankly, it's getting the most abuse right now. The people are saying that it's a little bit too restrictive, especially for small banks. Big banks, they have money. It's very expensive to follow these guidelines, but smaller banks may have some difficulties following all the Dodd-Frank rules and guidelines. So again, that's the basis of globalization and understanding a little bit about some of the regulation in the investments world.